All right, let's get right into it. For decades, we've all known Swift as the network for sending messages about money, but that's all about to get a massive overhaul. Swift is rolling out a blockchain-based shared ledger, and you've got to understand this is a fundamental shift. We're moving from just talking about a transaction to enabling instant programmable settlement. For banking executives, this isn't just another tech upgrade. It's a strategic crossroads, and sitting this one out is not an option. So here's how we're going to break it all down. First, we'll kick things off with the why. Why is this happening right now? Then we'll get into the what, the nuts and bolts of Swift's new architecture. After that, we're going to dive deep into the how with specific tailored playbooks for mid-market, regional, and super regional banks. And we'll wrap up with the stark choice that every single institution is now facing. So first things first, why the big rush? Why this massive evolution right this minute? Well, the push is coming right from the top. We're talking about international bodies and regulators who are getting really impatient. They are demanding better performance from the global financial system, period. And hey, don't just take my word for it. The Financial Stability Board, that's the G20's own financial watchdog, is basically sounding the alarm. They've put it in black and white. Without a major change in execution, those 2027 goals for cross-border payments, they're probably not going to happen. The current system just isn't cutting it anymore. And that's exactly where Swift's new architecture enters the picture. You can see it as a direct answer to that global pressure. It's a move beyond the old model of just sending secure messages, while the actual settlement happens somewhere else, hours or even days later. Let's dig into what that really looks like. At the heart of all this is the Swift ledger. Now, the easiest way to think about it is as a single shared source of truth, a validated transaction log that everyone can see. It uses blockchain tech and smart contracts to not just send an instruction, but to actually record, sequence, and enforce the rules of a transaction all in one go. And that opens the door to instant 24/7 settlement. This contrast right here, man, it tells the whole story. On one side, you have the world we all know, sequential messages, clunky batch windows, and all that painful manual reconciliation. On the other side is this new world of atomic programmable settlement. And atomic is the key word. It means the payment and the settlement are one single, indivisible event. It either all happens at once or it doesn't happen at all. This is what makes a 24/7 system possible, where compliance is baked right in from the start, not bolted on as an afterthought. And you should know, this isn't happening in a vacuum. There are three things making this possible right now. First, the move to ISO 2022 gives us the rich, structured data you need to automate everything. Second, Swift's own experiments in 2023 prove this is actually feasible. And maybe most importantly for all you execs out there, this is a parallel track. It's not a hard cutover, which dramatically lowers the operational risk for everybody. So here's the bottom line, and it's a tough one for some. If your business model, your P&L, is built on the old frictions, on profiting from batch windows, from payment float, from opaque processes, that world is ending. The new game, the new way to make money, is all about monetizing orchestration, data services, and compliance that happens in real time, right inside the transaction itself. So how does this actually play out in the real world? Let's get specific and break it down by bank size. We'll start with mid-market institutions. For this group, the big question is pretty simple. How do you tap into this massive shift without a massive budget? The opportunity here is huge. You're getting a capital-light on-ramp to 24/7 settlement. That means you can slash reconciliation times and, more importantly, free up all that precious capital that's just sitting there in your Nostro and Vostro accounts. The moves you need to make are clear. Focus on modernizing the edge of your systems. We're talking APIs and data handling. Then, pick one or two key corridors for your SME clients, run a pilot, and measure everything. But, and this is a big but, there's a major hurdle. Integration debt. Let's be honest, your legacy core systems were never designed for this new world. They just don't speak this language. And that is exactly why the smart strategy is to modernize your perimeter first. Build a buffer of modern APIs. That way, you can talk to the new network without the insane cost and risk of ripping out your core on day one. Okay, let's move up a tier. What's the play for regional banks? For this group, it's all about using your unique position. You've got that sweet spot of significant scale combined with really deep client relationships. The goal is to leverage both to create totally new forms of value. Because of your scale, even tiny efficiency gains can mean huge wins on the bottom line. But the real prize? That's in offering value-added treasury APIs, things like just-in-time FX or programmable payments for your corporate clients. So what are the moves? Don't just join pilots. Push for co-lead roles. Start building what you might call a bridge bank stack that can pull in flows from fintechs and large enterprises looking for a modern banking partner. However, the single biggest risk for regional banks is something I call governance drift. It's what happens while you're busy with internal projects. The global giants, they're in the room, setting the technical standards and the business rules for this new network. And you know the old saying, if you're not at the table, you're on the menu. You risk becoming just a price taker, forced to play by rules that squeeze your margins. And finally, that brings us to the big leagues, the super regional banks. For this group, the opportunity is way beyond just participating in the new ecosystem. It's about becoming one of its chief architects. This is absolutely the highest stakes play on the board. I mean, look at these opportunities. We're talking about shaping industry standards, monetizing compliance as a service for the smaller banks, and even operating the core infrastructure itself, like validation nodes. The moves are just as bold. Lock down those seats in the key governance bodies, run complex, multi-quarter pilots, and build the monitoring tools that will keep the regulators happy. But with great power comes great scrutiny, right? When you take a leadership role, you're putting yourself directly in the spotlight. That kind of visibility invites intense scrutiny. You absolutely cannot afford downtime, and every single rule in your smart contracts has to be auditable and defensible. The technical and governance bars here are incredibly high. So when you put it all together, it brings us to the final choice facing every single institution, no matter what size you are. With this fundamental shift in financial architecture underway, you really only have three options. You can lead, you can follow, or you can risk fading into irrelevance. And that brings us to the crucial question you have to be asking back at the office. As this entire network shifts its core function from just messaging to actual settlement, what role will your institution play? Are you going to be an orchestrator, a settlement hub, a compliance utility? You have to decide, because inaction is a choice, but it is not a strategy. And as you make that choice, just keep these 5 ground truths in mind. 1. Interoperability is the entire ballgame. 2. Compliance can't be an afterthought. It has to be native to the protocol. 3. Running old and new systems side by side is incredibly hard, and you need to treat it like a formal program. 4. ISO 22002 readiness isn't optional. It's your ticket to even play the game. And finally, 5. Focus where the durable money is, and that's central bank and commercial bank money. I'll leave you with this one final thought. This shift to a programmable, real-time financial network, it's happening. The early movers are going to be the ones who turn this architecture change into real client value and new revenue streams. And those who wait, well, they risk renting access to a future that someone else designed, someone else built, and someone else owns.